Welcome to another episode of IJS Speaks. This is your neighborhood financial economist, Katie Mark, and today's episode is titled Rectangle Chart Pattern, a Picture of Economic Uncertainty. The last 18 months have been a roller coaster ride across financial markets. But in the grand scheme of things, markets really haven't gone very far. And in most cases, sideways ranges have emerged as a result of all of the volatility. In the world of technical analysis, this type of price action creates a rectangle chart pattern. This type of consolidation can occur at the end of a trending market when buyers and sellers get to a point of indecision. Past the point of indecision, a breakout of the range in one direction or the other signifies a continuation of the previous trend or a possible reversal. The dollar rocketed higher while the Fed raised short-term rates by 75 basis points for most of 2022 and into 2023. The dollar index reversed as the Fed downshifted from 75 basis point rate hikes to 50 basis point rate hikes, which then consolidated into the lower bound of the rectangle pattern. Now, as the narrative of a soft landing for the US economy becomes more commonplace among some market participants, the dollar appears to be moving from the bottom of its rectangle towards the top. This repricing of the dollar reflects falling inflation in the US, paired with a resilient labor market. The dollar can be expected to continue to rally if inflation stalls out before getting back to the Fed's 2% target and if unemployment remains subdued. This leaves the door open for the Fed at any point to surprise markets with some type of policy tightening. The market for gold has been consolidating for the longest of all the markets I follow. The rectangle chart pattern started forming in late 2020 and has been very well defined. Within the last 18 months, gold and the US 10-year Treasury spent a considerable amount of time trading with a strong positive correlation, especially once the Fed embarked on the current rate hiking cycle. From its current level, gold can be expected to trend lower as rates remain elevated and central banks keep downward pressure on inflation. In this environment, gold loses luster as an inflation hedge and as the opportunity costs of higher yields accumulate. The US 10-year Treasury market is at the point of breaking out of its rectangle chart pattern, but the trade setup suggests higher rates are on the horizon. The downtrend in price leading to the rectangle chart pattern was made up of two bear flag patterns, so a breakdown of the rectangle could mean a return of downside momentum in fixed income markets. The strong positive correlation shared by gold and the US 10-year Treasury also suggests that the government bond market may experience selling pressure in the near term, as gold charts are also signaling selling pressure in the near term. The oil market is always an interesting one to follow. A lot can be inferred from the price of oil about industrial activity globally when adjusted for geopolitics. And if nothing else, the volatility can make your head spin. The market trended up from the lows of the COVID lockdowns when Russia and Saudi Arabia dumped oil onto the market in an attempt to bankrupt US shale producers, to the highs made post the Russian invasion of Ukraine. Then the market became concerned about the outlook for the Chinese economy, and the Biden administration opened the taps on the U.S. Strategic Petroleum Reserve, so prices retraced. This set up the rectangular chart pattern. When the market started rebounding on news of Saudi and Russian production cuts and the subsequent extension of those cuts. At current levels of consumer and industrial demand for energy, the production cuts planned by OPEC Plus will continue to build a shortage into the near-term market for oil. Consumer spending in Europe is most likely the linchpin maintaining upward pressure on oil. If Europe continues to slow, so will demand for Chinese exports and Chinese industrial demand for energy, which can take some of the steam out of the move higher in oil. The equity market, proxied by the S&P 500, rocketed higher from the lows of the COVID lockdowns to the start of the Fed tightening cycle in Q1 2022. Ever since, equities have traded fairly range-bound, albeit in a wide range. The current leg of sideways trading is taking the S&P 500 from the top of its range towards the bottom, suggesting that investor enthusiasm for risk assets is waning and profits are being realized. The heavy concentration by market capitalization in tech of US equities also means that as momentum in the 6 or 7 stocks that have been powering markets higher begins to taper, the major indices will react in kind. The last market segment that I track is the crypto space. Now, I do not consider myself an expert by any measure in the technology, so I assume I am at a disadvantage in discerning value in one coin or token versus another. Luckily, Bitcoin represents such a large overall share of the cryptocurrency universe that it makes a great proxy for the space. That being said, the trader in me still prefers to look at the futures market for opportunity. Now, Bitcoin finds itself trading in a relatively narrow range after a roller coaster ride from around $15,000 per token to just over $69,000 per token, and then back down to around $15,000 per token. The news flow around the regulatory environment in the US seems to dictate the oscillations in price of Bitcoin, wherein the price moves higher when there is perceived good news about regulatory clarity and lower when there is perceived confusion. Currently, Bitcoin is experiencing selling pressure, moving from the upper to the lower bound of its recent range, which is providing shorting opportunity in derivatives and other correlated markets. The effects of macroeconomic forces become more evident in financial markets when one zooms out and considers a medium-term time frame. At this vantage point, market context suggests indecision across the board, whether considering risk assets like equities, commodities, and crypto, or safe assets like gold, bonds, and even the dollar. The chart patterns, however, provide some sense of familiarity in the otherwise uncharted waters of a global coordination of central bank efforts to fight inflation by slowing economic activity. This has been another episode of IJS Speaks. This is your neighborhood financial economist, Katie Mark. When in doubt, take profits.